Hey everybody, this is the Kingscrowd Investment Roundtable. We are going to be giving you insights each week on everything happening in the online private markets. We will cover startup investing, any exits and failures in the news, and also cover our deep dive charts of the week where we look at different data for the industry. Today, we have two things on the docket that we're going to be talking about. First, there's IPOs. We've had two bigger IPOs over the past week that we'll be talking about that did investment crowdfunding rounds. Second, we'll be diving into our chart of the week, where we're going to be looking at, is the promise of investment crowdfunding living up to what it says in terms of being able to democratize access to capital? Since it is Black History Month here in February, we took a look at the data to see if the industry is holding up to that promise. All right, first off, let's jump into IPOs because there's been two IPOs in the news over the past week that we want to get some takes on. Now, the first IPO that we'll be talking about is Bionics. This is a company that actually did their first round on WeFunder back in 2016. Per WeFunder, I believe they were actually one of the first rounds to raise the $1 million under regulation crowdfunding. They went public and launched their IPO last week. Now, at the time of launch, it was roughly a $1 billion market cap, which, not accounting for dilution or anything else, but with a $100 million valuation first round on WeFunder would be a roughly 10x return for investors. So assuming there's some value dilution rather there, you can probably assume it's maybe a 5x to 7x return. But I'm going to bring in two of our guests here, Scott and Teddy, to comment on this first IPO. What do you think?
Yeah, I mean, it's always good to see companies in this space go public. I mean, it's generally seen as a positive thing when you make a startup investment. That's one of the two big outcomes you want: a big M&A deal or an IPO. Now, something that the industry has struggled with quite a bit. It's part of it's growing pains, part of it is just poor planning. But for these two IPOs specifically, Bionics, there was a bit of we've heard from some investors that they didn't really receive a lot of information on how to transfer their shares to their brokerage account so that they could actually sell their shares at the IPO price. Again, that's something that's just kind of seen as a growing pain of the industry. Like, that definitely needs to be figured out. The Cloudastructure one, however, I can let Brian kind of get more into that, but that one's more so just horrific planning and very ugly.
Yeah, so we'll introduce the second one here, and then Scott, want to get your take as well. So the other IPO that did launch on the NASDAQ on January 30th was Cloudastructure. This is a company that actually did multiple funding rounds online. I will give full disclosure, I actually invested in one of their earlier rounds, and it was about a $7 million valuation cap. So looks great on paper because here's this company that ostensibly has a $450 million to $500 million market cap at IPO. However, one of the things we see a lot is that getting access to your shares to be able to trade on those first days is pretty critical for investors if you happen to want to sell or get out. And usually it means you need to do upfront work of contacting your transfer agent or the custodian where your shares are held. So you need to find out where they are because they can be transferred several times before the IPO. Then you usually have to do something such as put in a DRS, which is essentially a transfer request to be able to transfer them from this custodian or transfer agent to your brokerage. That process can take sometimes upwards of 1 to 2 weeks. Then you can finally put in the sell order to say if you want to sell some of those shares. So oftentimes, it can be a long process. That's if everything goes smoothly. Now, unfortunately, with Cloudastructure, I invested on Republic, and one of the things we found out is that over the past year, Republic's custodian that they had used before was Prime Trust in this instance. And Prime Trust essentially declared bankruptcy last year. So all of the assets are not lost, but they are locked up essentially within the proceedings of this bankruptcy court until that comes to a resolution. So essentially what it means for me as an investor and for the other hundreds or 1,000 investors on Republic, unfortunately, is we're not going to be able to get access to our shares most likely until the bankruptcy court finishes those proceedings. I will say, in defense of Republic, they've actually been proactive in reaching out to investors and letting them know that they're trying to work with a custodian and basically the counsel who's in charge of those bankruptcy proceedings to make this go more smoothly. But again, it's just another issue of trying to get access to your shares. And it's, I think a little bit of a growing pain for the industry. These are kind of the first IPOs, but I'm going to bring Scott in here. There's been these 2 IPOs in the past week, but if you go to the Kingscrowd company exit tracker, you can look at all the IPOs, and I think we're up to 20 plus IPOs now. But it's a mixed bag in terms of how they perform after they actually go public. So Scott, what's your takeaway from some of this?
I mean, first off, one of the things I want to celebrate also is you can make money in a lot of ways. Pigeonly's in the middle of a bankruptcy, and I'm getting my $125 investment from 2017 back. So hooray for me. There's a lot of ways to handle it. I will say that there's two sides of this coin. One, I cited the Pigeonly thing actually for a reason. The bankruptcy has gone incredibly communicatively. Like, I'm aware of everything that's going on, and it's like exactly to the penny of what I invested and the date and the time, and I will probably get that money. And I think it's like a proof that like this isn't just some like bullshit thing where you put your money in and it just disappears and the founder runs away with it and it's gone and there's no recourse. Because clearly this is a company that I actually have met the founder several times and think very highly of, and just didn't work out. But like, there is a recourse. And in your case, you're talking about having your money tied up, which really sucks. And it's like, I mean, given not just crowdfunding, but like IPO performance in general, like you very well could have a $450 million company at IPO that's, I don't know, whatever, 20 plus what you put in at. And by the time you get access to companies worth zero and you just lose out on a win that's like a huge win. So I think that kind of sucks. I do think it is a part of this space. Obviously, Teddy talked about it, the growing pains. There's one, everything you talked about transfer sounds like a wonderful how-to piece to be published on kingscrowd.com for start, like just for one. But I think that because of how this industry had to come together almost in pieces, it was like this regulation enabled this thing, which enabled this, which enabled Title III of the Jobs Act, which then enabled Republic to do this, and then we did this and this and this. It's made it to where it's just very, very difficult because there's so many moving parts, and it's like there's no clearinghouse in the crowdfunding space that you just trust. It's not like, Goldman Sachs, which obviously Lehman Brothers went down, so it's not like that can't happen, but it's much more unlikely. I do think that this is one of the reasons, and I'm not a big like token digital type person, generally speaking, but I do think this is one of the reasons why technology has to play a larger role in our space going forward. Because when you try to run institutional tools that are designed to service, hundreds, not tens of thousands, shit breaks. And the communication layer that has to happen for any company to go public and issue public shares is so complicated that it is not, in my opinion, like super unforeseen that you would miss out that 7 years ago you took an SPV from X platform that had 10,000 people in it. It's a complication, a wrinkle where if I'm the IB taking said company public, I might tell you, like, just fucking forget it. Like, let's just deal with it later, because it's just going to be a huge thing to uncover. So I think this is probably a huge opportunity for you founders out there who are in fintech, regtech, to try to build a solution, because I do think that while this is a growing pain, it is a growing pain that doesn't really have a solution so much. It's not like you can be like, oh, we didn't know. Like, we do know. Everyone knows that this is complicated. There just isn't a really good solution.
Yeah. And I think we've seen that just, personally speaking from my own portfolio, I probably have shares now that are in 10 or 12 different custodial accounts, transfer agents between, and some of those are traditional, right? Like everyone's probably heard of, or a lot of people have heard of, like Computer Share, vStock Transfer. These are big ones that would be used for traditional stuff. And there's newer ones as well, right? And I think, Securitize, but actually like Start Engine has their own transfer agent, I believe, Silicon Prairie. So there needs to be more technology, I agree, in terms of just making this work for this industry, because it's perhaps a different business model when you have, to your point, tens of thousands of $100 investors. That's very different than $110,000 investors, and like managing that and making that work from a customer service perspective, right?
Yeah, I definitely agree. But it is, like I said, it is very cool to see a couple companies go public, even if it doesn't necessarily mean that they become the next Reddit or whatever.
Yeah. And these are still huge wins. So again, for Cloudastructure, I invested on Republic, but there's people on WeFunder who I don't know the situation of the investors there who invested earlier. That was a little bit higher, but still not very high valuation, I believe. They may have access to their shares. So, depending where you invested, you need to definitely just make sure you know what's going on, how to get access to that if you want to sell. But both of these, theoretically look pretty good in terms of the time at the IPO, which some other ones have not always looked so great in terms of the market cap versus what you invested at. So it's at least encouraging. Right. Awesome. Well, let's wrap up on that discussion with IPOs. Scott, thanks for joining us again this week on the news segment. We'll let you get running off. In the meantime, I'm going to invite our other analyst from Kingscrowd, Leah, to join Teddy and I, and we are going to talk about this week's chart of the week. So the chart of the week that we published this week, and again, we put out a weekly chart where we do a deep dive into the Kingscrowd data set, was taking a look at are Black founders able to get access to capital and getting more of this democratization of capital that these online private markets have promised. So regulation crowdfunding, Regulation A are great because traditionally, a lot of us have seen the stats, the 97% plus of white male venture capitalists who tend to be the ones who are the traditional gatekeepers. And whereas when you come into the online investment crowdfunding space, it's being able to open up more of those investment opportunities to more diverse backers. And theoretically, right, being able to give more access to capital to entrepreneurs, to founders, to those issuers who wouldn't have been able to originally get that from VC. So I'm going to pull up the chart and we can dive into this week's chart. So when we pull up and take a look, what we can see here in this first chart is we're looking at the overall percent of deals from 2023 to 2024 with Black founders. So in purple here, that bar means that the founding team had at least one Black founder, and the green bar here is showing that it's an entirely Black founded team. What we can see overall in terms of regulation crowdfunding and Regulation A is that we see 14.6% and 12.5% respectively in terms of overall deals with Black founder representation. Now, this is very encouraging. If we compare this with US Census data, that puts the number in terms of the Black and African American population in the United States at around 13.7%. So we can see there's relatively representative number of deals here that align with that number and that representation of the population. However, one interesting thing is when you break out those deals in terms of looking at equity-only deals, so taking a look at common, preferred, safes, and convertible notes, we see much lower numbers actually. So it's only 10% with at least one Black founder. Whereas if you take a look at debt and revenue share deals, it's higher percentage, 21.4%. So to me, what this kind of says is that Black founders are, while overall being represented well within regulation crowdfunding, the types of capital that they are seeking, whether it's more of that debt financing versus kind of that high growth equity capital, does seem to differ. I'm going to pull in Leah here, who's joining us to give some commentary. Leah, you look at a lot of different deals in terms of the online markets. What do you have in terms of takeaways looking at some of this data?
What I'm seeing here is that Black founders are underrepresented in equity deals, but overrepresented in debt and revenue share deals. And while I don't have a clear explanation, I think we can give a little bit more context. Equity deals are similar to VC deals. These are startups deals where investors want to see a 10x, 100x return over the next couple of years in order for them to make large return and compensate on the risk of buying equity into a startup. Debt and rev share are mostly going to be small businesses, and we see a lot of restaurants, for example. So that can be sometimes a way for people to create their own jobs, but also to try to build wealth and not be dependent on employment.
Yeah, I think what you pointed out is definitely accurate. And just one other layer to add on top of this in terms of the insights. So again, while we're seeing roughly equivalent representation from Black founders, like from a population perspective, the amount of capital being raised, unfortunately, does not tell quite as good of a story. So when we look at how much capital is actually being raised by those 13% or 14% of companies, we see in 2023 and 2024 that Black founded teams only raised 4.4% of all capital for the online private markets. Now, that trend is increasing year over year. So we see in 2023, it was 4.1. In 2024, it was 5%. And additionally, if we compare that to VC, it's miles better. In the first half of 2024, Black founded teams only raised 0.3% of all venture capital funding, which is basically on par with the 2023 number where they raised 0.5% over the entire year for Black founders. So we do indeed see that this is almost 6x that number in terms of what's being represented when you compare 0.5% versus 4.4%, almost up to 10x. However, there's still a gap that needs to be filled. So I'm going to bring Teddy into the conversation here. But Teddy, what do you think when you look at all these numbers, and what does this say to you?
There was a study by Columbia Business School last year that basically found that only 3.5% of founders seeking funding from VC firms were Black. So even to get into the VC kind of pipeline, get into the pitching room, there's a lot of barriers there. So I think it's complicated issue, but of course in VC it is very pronounced, the discrepancy there. And so I think overall what we're seeing in equity crowdfunding that we're seeing more and more Black founders kind of launch raises, and as the industry kind of continues to mature, I'm hoping the funding side kind of catches up to that.
Yeah, and just taking a look at some of the other minority-owned businesses using Reg CF and Reg A. So this is not the number of deals; it's a slightly different cut of the data, but this is of all the founders out there who are seeking capital, what different demographics do they kind of fall in? So what we do see is this is from 2020 to 2024. We actually took this 2020 to 2022 data from one of the SEC reports that looked at different minority-owned businesses done by Dr. Melody Chang at University of Southern California in collaboration with the SEC. And then we supplemented that with 2023 and 2024 data from Kingscrowd. But we can see that different minority groups are using equity crowdfunding more and more. And this is rather broad investment crowdfunding. This includes both equity and debt. I think, again, it's telling an encouraging story in terms of the trends and the potential, but we see that there is still a gap. There is a funding gap there. There probably are still biases in the investors, and we will monitor that, obviously, and look at the data as we evolve in the coming years.
Equity crowdfunding is the democratization of investing, but it's also the democratization of access to capital. And we see it here with Black funders having a way larger share of funds invested online versus funds invested through VC. And that shows that it's probably kind of easier to access capital. And it may be for a variety of reasons. It may be because there's less barriers to access the investments, because when you want to raise through VC, you technically kind of have to have the network and have to pass kind of that human filter where there can also be a bunch of biases.
Great. Well, I think we're going to continue to watch a lot of these different trends moving forward. We'll absolutely be reporting on this. I think we've had a great discussion. We can wrap things up for today. Again, for everyone who's watching this, if you want great data-driven insights delivered directly to your inbox every single week with more great analysis, charts, insights like what we've talked about today, make sure you head over to kingscrowd.com, sign up, create a free account. That will get you the free weekly newsletter with all of these data-driven insights. And you'll also get access to the platform where you can use different tools such as our exit and failure tracker to track some of those IPOs like we discussed. Until next time, we'll sign off and we'll see everyone back here next week.